SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-BAFFI Bocconi e-lecture on key takeaways from the ECB's November 2025 Financial Stability Report. While the global real economy is slowly adapting to major policy shifts, uncertainty remains elevated amid persistent geopolitical tensions. Global and euro area financial stability may be at risk from several directions. Policymakers, investors, and the public at large are intensively discussing questions such as: have financial markets gotten ahead of themselves? Are they out of sync with real economic reality? Are we amidst multiple bubbles? What risk might stem from fast-growing stablecoins and highly volatile crypto assets? How big are cybersecurity risks for financial stability? How about sovereign debt markets? How fragile are fiscal positions in the face of additional spending needs for defense, aging societies, and climate, and in the event of shocks further straining public finances? What threats might banks, despite their sound position, face if some real economic sectors suffered severely from global trade fragmentation and tectonic shifts? What fragilities might stem from non-bank financial firms? Are real estate markets, notably CRE markets, out of the woods? What spillovers, also globally, might we have to cope with? These and many further issues are dealt with in detail in the latest ECB Financial Stability Report, which was released yesterday on 26 November 2025. We're privileged to have the ECB's leading mind behind the FSR with us today to present key findings. A heartfelt welcome to John Fell, Deputy Director General, Macroprudential Policy and Financial Stability of the European Central Bank, and John is also a SUERF Fellow. John's presentation will be followed by comments and further inputs by two top financial stability experts. A warm welcome to Ádám Banai, Executive Director, Monetary Policy and Financial Stability, and Chief Economist at Magyar Nemzeti Bank, and to Cristina Cella, Advisor, Financial Stability Department at the Sveriges Riksbank. Without further ado, over to you, John.
Many thanks, Ernest, and on behalf of all my colleagues who worked on this edition, thanks for inviting us back. We always appreciate the opportunity these SUERF Bocconi seminars give us to spread our message, and also for the feedback that we get here, both from the discussants and from the audience. It always helps us, I think, to stay relevant, and so we really appreciate it. So if I dive straight in, our overall assessment in this issue is that sources of risk and vulnerabilities for financial stability remain elevated. You can see that there on the headline on that slide, and that's because of geoeconomic uncertainties and because the full impacts of tariffs have yet to be seen. We did a word count of this issue. There's 50,000 words in it, so there's a lot. I'm going to try to convey the essence of the narrative in the next 15-20 minutes or so through the lens of these three areas that are on the side there where financial stability risks look to be most pronounced. So you can see there, first we see a risk of sharp, disorderly, broad-based market adjustments, which could be amplified by non-bank fragilities. Second, challenges for the fiscal outlook could test the confidence of a more flighty and news-sensitive investor base. And then third, banking sector exposure to balance sheet fragilities in non-financial sectors, particularly corporates on the asset side, and growing reliance on non-bank financial institution funding on the liability side could be exposed in a financial stress episode. Setting the scene, the context in which this assessment was prepared, US tariff negotiations remain front and center, as they did back in the May issue. And now while there have been some temporary easings, particularly between the US and China, that have taken place, and effective tariff rates have eased, tensions still remain. The agreement that was reached with the EU in July, adopting a 15% flat tariff on most EU goods entering the US, it did avert transatlantic escalation, but some sectoral disputes are yet to be concluded. So far, though, the initial disruption to economic activity, and I think this is the case both for the US and for the euro area, has been less severe than was initially expected. The narratives are a bit different, though. For the US, it's explained by, well, new trade deals, exemptions, and particularly, I think, front loading of imports, and the adaptation of supply chains, which take a little bit longer. For the euro area, well, I mean, one of the explanations is that new tariffs only became effective in September, but of course, I mean, businesses would have had expectations and would have been responding to what they thought tariff rates might be in the future, and we did see some. The leading indicators, such as the purchasing managers indices there for services and manufacturing, you can see that they actually remain in expansionary territory, even showing a modest recovery at the margin since the announcement of reciprocal tariffs. Even the automotive sector, and you can see that there, the red line in the middle chart, more exposed than most to trade frictions. Has shown a recent uptick, although that series has been volatile and the sector remains fragile, as we know. But overall aggregate economic activity figures portray a similar picture of limited effect so far. You can see that there on the right. Now, that said, varying tariff sensitivities, because we know there are different sectoral exposures across countries, that remains hidden in the aggregate data, and so those the heterogeneity across the cross-country heterogeneity can't be seen in the data, and of course the full impacts, as I said, have yet to be seen. And at the same time as all of this, the possibility that growing US fiscal imbalances could ultimately trigger a bond market correction and push the dollar down, similar to the kind of market impact that we saw when reciprocal tariffs were announced in April. It's still considered to be a major threat. We hear this a lot in market intelligence when we meet with people who are on the coalface, so to speak, in markets. Could we see a repeat of what happened in April? Well, the US Supreme Court heard oral arguments on the legality of reciprocal tariffs on the 5th of November. And many commentators see a real risk that the court could limit or even invalidate the use of the International Emergency Economic Powers Act, which was what was the legislation that was used for the tariffs. That they could limit or invalidate the breadth that was imposed via that act. Now, some justices did express concern about disrupting ongoing trade policy and the possibility of tariff refunds should the measure be struck down. So giving the money back to the payees of tariffs. It looks like uncertainty could remain with us until, well, seems like the latest would be June next year, and that date is determined by the current term of the court. Although an opinion could be given any time before that, so it hangs over us now between now and probably the next issue of the Financial Stability Review. Now, if found illegal, the expectation is that reciprocal tariffs would be substituted by sectoral tariffs, and the reason for that is the reliance of US budgetary arithmetic and the big beautiful bill on tariff revenue. Now, with many European investors in key US markets still underwater, you can see that there on the right, thanks to the rise of the euro. These concerns have been inducing US dollar hedging to a greater degree than we have seen in the past, but not avoidance of US markets. And I think that's important, because AI exuberance has been too strong for that. Gathering market intelligence for this issue, one market participant phrased it this way to us: I would like to be invested in NVIDIA but in euro. Moving to the first set of vulnerabilities, a recurring theme in our discussions with market participants has been a disconnect between, on the one hand, heightened geopolitical risk and trade policy uncertainty, and then on the other, compressed asset price risk premia across the board, which seems to not match what the degree of uncertainty that we see. Now, the issue is not new, and market analysts offer a range of explanations from the investor complacency to belief in policy backstops to the difficulties of pricing binary risk outcomes. So geopolitical outcomes or political outcomes can be harder to price than kind of, more continuous, trying to price assets on the basis of continuous time series. Now, one thing is for sure, and you can see that there on the left, so-called market drawdowns. So this is the decline in the equity market, and you see this in the US as well, declines from peak to trough. They've become shallower and they've become shorter lived, with buy the dip tactics pushing valuations higher and higher. You see this almost on a daily basis nowadays. Now, there's also a focus on concentration in markets, and that's thought to have broadened the range of possible shocks which could unravel hard to explain valuations. So we've seen it with NVIDIA's earnings reports. They've become just as important a source of market volatility as the non-farm payroll report, which is most unusual. I don't think we've ever seen this before, and that makes the scenario somewhat more plausible. One observation is that the frequency of daily $100 billion shocks to individual market capitalizations, negative shocks, has become almost a regular occurrence. But it hasn't yet had a significant wider impact. Now, one explanation that's given is that negative correlation, diversification. So you have some of the bigger firms in the US having 1 billion negative shocks and others having 1 billion positive shocks. So there's a lot of volatility going on at the moment. But we advise caution, and certainly not to, not to use this as a reason for being complacent, because as interconnection between the large tech firms at the center of AI exuberance is increasing, and it's increasing through both closer financial and operational ties. So firms investing in one another, but also selling their inputs or their outputs to buying inputs or selling outputs to one another. Now, as this progresses, it becomes more likely that shocks will progress, will propagate rapidly, synchronizing both cash flow shocks and investor perceptions. And this, we think, would have knock-on effects if it were to happen for Euro area non-bank financial institutions, sector holdings of US assets. Now, not only have they become larger, many Euro area asset managers use, for example, the MSCI World as the benchmark, which has a very large fraction of US equity in it. As you can see there on the right, it's not often that both equity and credit exposures have been so richly priced at the same time. Just to explain the chart, we've got price earnings ratios and spreads. So when the blue line goes above the dotted line, then it's in more overvalued territory, whereas on the bottom one, it's the spread. So when that becomes more compressed and it goes below the yellow dotted line, then it becomes more. Then you can say the corporate bonds and corporate credit generally is overvalued. So you can see, I mean, there's plenty of periods where one or the other was on the other side of the line, but it's not often that you see both. Turning to sovereign risk. With the notable exception of French spreads, Euro area sovereign spreads have been converging since the middle of last year. Now, this undoubtedly reflects the substantial progress that countries made in bringing debt levels down since the pandemic, and then it's been a bit turbocharged by flight to safety dynamics this year, especially in April, at the time of the announcement of the reciprocal tariffs, and it has persisted, where we got a compression of risk premia across the board. Now, we still know that there are pressures on public finances, and those pressures are are hard to ignore. Several euro area countries are still burdened with high debt levels, and they are now facing a range of new demands to tackle a range of structural challenges. The most prominent, of course, and the one that we see most frequently in the media, is the pressure to ramp up defense spending in response to shifting geopolitical realities. But additional spending will be needed for the green transition, digitalization, shifting demographics, and other necessary improvements to improve also euro area productivity. Now, if these investments are well structured, we continue to think, and we say it in the review, that they have the potential to support growth. And we don't just mean the fiscal, the Keynesian demand effects in the short run, but we're thinking also more long term. We're kind of thinking more about, you know, long term supply side enhancing, better growth quality and so on, that could come from well targeted investments. Now, if they fail to seize the opportunities, and you know, we don't get savings from coordination, we get duplication, for example, across countries on where there would have been an opportunity for coordination, then I mean we see a risk that they would simply add to the debt overhang. So this is kind of important going forward for fiscal sustainability. Now, with these vulnerabilities in the background, we're also drawing attention to shifts in the investor base for euro area government bonds, which may make market functioning a bit different to what we have been used to over a considerable period of time, following the end of net purchases and reinvestments under ECB quantitative easing. The share of euro area sovereign bonds held by the euro system has fallen, and of course, shares always add up to 100. So we have banks, we have investment funds, foreign investors increasing their presence. And at the same time, issuance patterns have been shifting towards shorter maturities. You can see it there on the left. We take that to be because of declining interest rates. But this, we're going to have a more diversified investor base. And now, is that going to be positive or negative for financial stability? But it can be a bit of both. It should make bond markets more liquid. But equally, it's likely to make them more news sensitive and flighty. In other words, markets we think are likely to be less forgiving to adverse shifts in sentiment than they were in the most recent past, and that has the potential to amplify sensitivity to, say, global shocks, like, for example, if we did have a sudden upturn in long-term interest rates in the US, or euro area fragmentation risks that could come out of, for instance, differential impacts across countries to tariffs, given different tariff sensitivities. The third source of risk, now, while some data sources such as Eurostat bankruptcy data, there you see it there on the left, are flagging rising corporate sector vulnerabilities, that we're seeing the number of bankruptcies is increasing. But it's not feeding through to the non-performing loan data of euro area banks yet. Now, since the main statistical unit for this bankruptcy data is the legal unit, so normally a firm, and not distinguishing by size, the lack of impact on NPLs probably means that the firms that are going through bankruptcy now are mostly of small size. But that doesn't mean that this data is uninformative, because I mean, we know how credit cycles play out. It's usually the suppliers of larger firms that fail before the larger firms ultimately fail, and we're seeing that. I mean, I think the auto sector is just one good case study that we're seeing now, where we're seeing suppliers to auto manufacturers, car part manufacturers and so on failing. So this is something to watch going forward, especially in tariff sensitive and export oriented sectors, such as the ones that you can see there highlighted on the right. Manufacturing, for instance, and not only does manufacturing account for, there's a lot of dimensions on this chart, but not only does manufacturing account for a high share of total value added, and employment, which is shown in the chart, but it also accounts for a large fraction of total bank credit. So this is a vulnerability that we're keeping an eye on. Right. So that was, I mentioned at the beginning that there were asset side and liability side vulnerabilities for banks. Now on the liability side, we dug a bit deeper into this in a special feature, which summarizes an emerging vulnerability, namely the growing reliance of banks on the non-bank financial institution sector for funding. So because this type of funding is often short-term, it's often highly concentrated, and it's often tied to specific market activities, such as repo transactions or dealer financing, it can be hard to substitute. Now, it can be substitute, but it can be hard to substitute, but especially at times of stress, it can be hard to substitute, and that's what we worry about. Since 2021, you can see their NBFI funding has risen by around €1 trillion, NBFI funding of banks, and is reaching more than $4.5 trillion now, equivalent to 17% of total banking sector assets. That's already a sizable fraction of total banking sector funding, but actually those figures don't do full justice to the vulnerability, because the funding is highly concentrated among relatively few systemically important banks. So to give a sense, the top 5 largest banks account for about 3/4 of total sector repo funding. Now, since hedge funds and other non-bank financial institutions tend to react abruptly to market developments, so again, the flighty, the news sensitive type of market participants, redemptions or margin calls could result in a withdrawal of bank funding. With the size of that liquidity contraction, depending on how leveraged the lenders are at the time that a shock hits. So there's a vulnerability that we're also keeping an eye on. It's not clear, though, if either of these asset or liability side vulnerabilities that I mentioned are being priced by financial markets. If anything, I mean, Euro area bank stocks have been doing incredibly well over the last couple of years. They rallied strongly in 2025, actually making the sector one of the best performing asset classes, both regionally and globally. The Euro Stoxx Bank Index now almost double what it was at the start of last year. That surge has been driven by a combination of factors, including strong bank earnings. We had also a change in the direction of the monetary policy cycles and anticipation of monetary easing, supportive stress test outcomes that we had in the summer, and also record shareholder distributions. So both through dividends and importantly, which is a bit new in Europe, buybacks, share buybacks by banks. Now, thanks to this, as well as the return on equity edging a bit higher, Euro area banks are now earning more than their cost of equity and more than they were before. At least this is what convergence of price book ratios to 1 for the first time since the global financial crisis would suggest to us. So overall, in an environment where the frequency of future shocks seems set to remain high, confidence in the shock absorption capacity of the banking sector is a positive factor for financial stability, notwithstanding the vulnerabilities that I mentioned. Unfortunately, we're not able to say the same for the non-bank financial institution sector, because we have many blind spots on that sector, but we are trying to shine light on those blind spots as we did hopefully in the special feature. Now, before concluding, very often the question is posed to us whether this issue of the FSR, whether it's more gloomy than it was last time or not. And up to now, I'm sure you've asked me this in the past in these webinars, Ernest, our answers have, speaking frankly and euphemistically, they've been more judgmental than scientific. Now, we did show some time series for tech sentiment in a special feature that we had, that colleagues and I drafted for the 20th anniversary issue a year ago. That gave a kind of a sense of, it helped us to compare the tone from one issue to the next. But it was backward looking, it wasn't real time, and it was not artificial intelligence based. So since then, we've been making advances with large language models, which have been helping us to understand and reflect on the tone that we wish to convey in the FSR. Now, it's still a work in progress. I don't have a chart, unfortunately, to show you, but I can say that this edition of the review is a little less gloomy than the one that we published in May was. Now, it's usually, herding is often a bad idea when you're involved in anything to do with the financial markets or assessing financial stability, especially which is a contrarian business. But we couldn't resist taking a peek at other peer financial stability reviews. So we looked also at the IMF GFSR and the Bank of England's FSR. Don't want to make comparisons with FSRs in other jurisdictions of the euro area. But in line with us, both actually using the same framework, their recently published FSRs are also slightly less gloomy than they were than our previous ones. So relatively speaking, yeah, we think risks have come down slightly, and we are, by the way, between the two. Now, with that, let me conclude with the main macroprudential policy messages that we have in this issue. We're underscoring, you can see the main messages there on the slide. We're underscoring the importance of maintaining bank resilience, addressing risks in the non-bank financial sector. I hope with the presentation that I've given you have some sense for why we're saying that. Simplifying regulation and advancing both the savings and investments union and also the banking union to safeguard financial stability. Now, specifically on maintaining banking sector resilience, our view is that prevailing releasable capital buffer requirements should be maintained. So this is not a time to be releasing capital, while targeted increases in buffer rates could be considered in those countries where releasable buffers are low. But we do condition that on, I mean, we don't want to tighten macroprudential policy if it would give rise to procyclical risks where it would make the situation worse rather than better. For non-banks, the message is not new, but the relevance is increasing given their growing size and their interconnectedness with banks and core markets. We continue to advocate for strengthening the macroprudential policy framework for non-banks, including broadening the policy toolkit to address liquidity mismatches as well as leverage and concentration risks. This is our one-pager, our cheat sheet of the main messages in the whole FSR. So if you've only got 2 or 3 minutes, it's all there. The three sources of risk, and why we, with some explanation for why we are highlighting those vulnerabilities in particular. I think I can stop there.
Thank you very much, John, for this overview. I can tell the audience that John covered key ideas of the FSR, but by no means covered the full content. So I want at the same time to encourage everybody to have a look at the full report. Now, let me hand over to Cristina. The floor is yours.
Thank you for giving me the opportunity again to discuss the key takeaways actually of the ECB. As John was saying, the ECB Financial Stability Report is kind of a very extensive work. So it wasn't easy to try to navigate through it. And I'll try to give you some general picture and some more suggestions for the future editions as well. I work at the Financial Stability Department of the Swedish Central Bank, but I'm a research economist at heart, at work actually. So I try to take that perspective when I was looking at the material that I received. And I try to come up with some comments I hope will be helpful. As I just said, the ECB FSR is extensive. It's usually, and in this case, it makes no exception, very rich in analysis. And this analysis, I mean, I wish I had access to half of the data and the main power that the ECB has. So I'm very jealous about all of it. But actually, it's great. I think it's great to see a conclusion made on actual data and analysis. I think that's very important because it gives us a much more confidence in the work that you do. So I think I'm always very impressed by it. So, and I really liked, of course, the special boxes, the future. I didn't manage to read all of the special features, but I read the one on crypto, on stable coins, which is something we have been also working a lot at the Swedish Central Bank. And I will say that in sense of message and general analysis, we are also very much aligned. So it was, we published like 3 weeks ago. So it was interesting to see how basically the main topics are so kind of shared commonly by also different central banks. As you were saying, also the IMF and the UK have had similar discussions. What my discussion is going to be about? First, I will just quickly kind of summarize what John just said, because his presentation was rich in analysis and graphs. My presentation will not have any graphs. And then I will do an experiment with artificial intelligence to see basically whether artificial intelligence can help us gain some efficiency and productivity, and basically think a bit deeper about also the FSR itself talks about artificial intelligence, but there have been many discussions about it. So I thought, why not? Let's give it a try. Let's do an experiment. And then I'll give you some comments about additional analysis for future editions, right? So in the next slide, I will just take a very quick look at the main official conclusions of the FSR. The main official conclusion, as John just said, is that financial stability vulnerabilities remain elevated, which I think is a common view. And this is mostly driven by uncertainty over geoeconomic trends and the impact of tariffs. Now, the main risks that he has discussed and highlighted are trade policy uncertainty, sovereign debt sustainability, sizable fiscal spending, and I would say also maybe unsustainable, in many cases, fiscal spending, high asset valuations, especially in connection with artificial intelligence and big tech firms, and the risk of contagion between banks and non-banks, given these new interlinkages between the two sectors. Okay, one positive, let's say, silver lining is that the system for so far has shown good resilience, and is positive, and we need to keep working on this resilience to make the system even stronger in the way forward, right? So I would say that this is the main message of the FSR from the material I've actually looked at. But then in the next slide, let's do an experiment, all right? So I wanted to be creative. Yesterday I was thinking about this, how to approach this. It's such a rich analysis. Many things are actually difficult to argue with, right? So we can also only think about the way forward. So what did I do? I manually searched the FSR manually, just by myself, for keywords that were in John's presentation, and also for a few words about topics I work with. Then I counted again manually, so I did not do any language modeling. And I know, John, you just mentioned that you actually also enjoy this kind of experiment or support tools. I did it by myself, so very very quickly with Control F on the PDF, so very basic. And then what I did, I counted how many times this word had been used in the FSR without considering or checking the tone at which they were used, because I did not have a language model to use, not so much, not even the context, right? And then what did I do? I fed the search I made to the artificial intelligence. In this case, I cannot make an advertising, but the one that is internal to the Swedish Central Bank, without giving access to the artificial intelligence to actually either the FSR, nor the slides. Okay, this is offline. So it was offline, it cannot get onto the internet and search for it. So what did I do then? I asked the artificial intelligence to visualize the words I was giving them based on the usage of the words. And then I asked them to use these words or it. I was actually very sure about how should we refer to artificial intelligence. So I call it it. I actually asked it to write a sentence using these words and to make a conclusion using these words about what is the financial stability situation in Europe. Okay, then what did I do? Then I gave the artificial intelligence the actual FSR, and I said, now check, are your conclusions in line with what they have actually done? So let's see what the results are, okay? So this is the experiment I did. So first and foremost, although the main conclusion talk a lot about geopolitical risk and tariffs, if you look at the FSR itself, 3 themes are very relevant. I did not search for the word United States or US because that would have taken the entire page. So sovereign, non-bank financial institutions, and leverage. Basically classic. Okay, so the problems that we have discussed and have been around for a long time are still here. Sovereign now have taken different shapes and forms, leverage different shapes and forms, but of course a lot is about the corporates in the European economy. And non-bank financial institution is actually a sector of which we have been talking for a long time, right? Regulation, transparency, lack of data. It is definitely prevalent also in this version of the FSR. Then actually, let's see, putting together these words and the relevance. For example, the word geopolitics or tariffs is actually not very much used in the FSR itself, even though it's so prevalent into the conclusion, right? So what did, can you please change the slides? I'm sorry, I was trying to change it myself. So what did the AI make of these words? What is the conceptual grouping that the AI did all on itself, okay? It's saying, in a financial system increasingly driven by non-bank financial institutions and sovereign priorities, the banks and countries' strategic behavior sit at the core of risk transmission. Managing uncertainty and building resilience are vital as tariff, sovereign debt pressures, and geopolitical tension interact. At the same time, advances in artificial intelligence and cyber capabilities reshape competitiveness, while persist hybrid threats increasingly intersect with climate-related vulnerabilities. Which I found, I actually had read at least the first part of the FSR, and I thought that was actually quite spot on. And then when I actually fed the artificial intelligence the actual FSR, and I asked, so what do you think? Do you think that your conclusions are in line? He replied, or she replied, yes, I think they are very much aligned, which actually is a clear example that, yes, maybe we have high asset valuation for what it concerns big tech and firms that are very much invested in artificial intelligence. And there are costs related to artificial intelligence, but the gain in efficiency and productivity that this tool can give us can be extremely relevant for the future of our society. We need to be skeptical and vigilant, and we need to build resilience. And as Sasha Stefan said, we need to look at the most likely credit condition rather than asset pricing, the asset of prices, right? Prices. But we still need to believe in the tools. We can make actually with some guided by people, these tools can really improve productivity. At least I think they did help me a lot. And also helped me a lot shape this big picture in order for me to think about what can we do more? What is actually something that we could discuss more? I will take 3 minutes in order to have a lot more slides, but the next slide I think is the most relevant, and then I can conclude there. So a few more things that actually could be, I think, more directly explored or more explicitly explored into the FSR as I read it. It's definitely the role of big tech and their interaction and their interaction with I'm not completely sure I'm in the right it's the right word, but with the digital euro angle. Then the distributional political effects of geoeconomic fragmentation, because it's definitely going to have heterogeneous effects within even the EU. Structural trends like aging, productivity, and pensions, I think those are very key themes that we are also exploring more here in Sweden. But in general, I think we should talk more about the interaction between real economy and financial stability. And this year, Nobel Prize is all about creative destruction and innovation. And this made me think about the Draghi report, right? Where are we standing on competitiveness? This is one of the words that I see very little in the FSR. So I think one could work more in understanding these linkages. And then again, are we something that could be explored maybe more deeply in the future? It could be actually the possibility of an AI bubble, but also the importance I will say again, find again a dialogue about climate-related risks and nature-related risks. There is some mention about climate-related risk, but nothing about nature-related risks. We recently had a conference about the effect of nature-related risk and climate risk on commercial real estate. And since commercial real estate is a sector that is also very important in the European Union, I think it would be very important to start thinking about these issues again. I know that the ECB works a lot on these issues, so it's not something that they are not featuring, but it's not in the FSR, and I think it could actually bring more light on these issues, because it's clearly very important for many of the relevant sectors, manufacturing, agriculture. This is not only tariffs, there are other risks that play a big role for our economies. And then maybe also about periphery countries, right? They are one of the reasons why the spread with the German bond is actually decreasing is also because Germany has had its fair share of problems themselves, right? Their economy has been not as strong as we used to think about it, but also the periphery countries are doing a much better job, but they still are suffering from brain drain, which is a big problem, for example, a big structural problem that we are not able to revert. I always try to think about the biggest differences between geopolitical risk and geoeconomic risk, but in this particular case, right, when we think about geopolitical risk is basically in the FSR has a large, not explicitly, but it definitely has a very large role. And basically the analysis spans about macroeconomic, sovereign banking, non-banks, financial sector, and so on. But I think one could exploit more the heterogeneity in the vulnerabilities. Not all countries have been affected in the same way. Not all sectors are going to be affected the same way. There are big sectoral changes. Even within sectors, we know that some companies are going to be affected more than other companies. So given that one could actually get the data, it would be very interesting to do more analysis about geopolitical risk. I'm actually working on geopolitical risk myself, so I know that it's not actually straightforward to do this type of analysis. But I was also thinking about potential, basically, harmonization of cross-border regulation we talk about, which also spans toward geoeconomics, like harmonization of rules, transparency, things that we also want to apply to non-banks financial institutions, for example. So here again, think through basically how can we further work in minimizing geopolitical risk or the effects of geopolitical risks. In the next slide, I was thinking also more about geoeconomic risk, right? I think my message is mostly about peace, right? I think many of these problems would be solved if we could actually have a more peaceful period. But we need to continue with vigilance, and trade-related policy has to be monitored very, very, very closely, as John was also saying. We know that there is a tendency to also disregard the court's ruling. So there's also a very important topic. Macroprudential measure could be tailored in order to mitigate these risks. And also, of course, if we had the data and we had the instrument, maybe deepening quantitative modeling, analysis, and also understand better the linkages to operational policy framework. And that basically concludes my presentation for today. Yes, the ECB, as usual, provides very important insight. Recent events usually provide substantial food for thoughts, and I can see that, it keep being the case. We are never short of interesting events that affect our economies and our financial system. And I'm sure that we will not wait to see further improvements in their analysis and more interesting insights from the ECB, because that's usually the case. So thank you, John, for the opportunity.
Thank you, Cristina. I think these were quite interesting points. Thank you very much. It's now my pleasure to hand over to Ádám. Over to you.
Thank you very much, and thanks for the opportunity. As the report is very rich, I decided to just bring up some topics and give a little bit provocative question to John, not to give him hard time. I know that I cannot give him hard time, but I'm really curious on his answers. This is about government bonds, because government bonds and fiscal policy was also in the core of the financial stability report, and Hungary is kind of related to this. And I think it is still very interesting that in some countries it is increasing against. I mean, the exposure towards sovereigns within the banking sector, and as you see, Hungary is among the highest ratios, and what we expect by the fiscal outlooks, especially that there are a lot of needs for NATO expenditures, is that possibly it will go further. And I think it is always a big question. What is the threshold to think it as a new type of risk for the banking sector? For sure, we in the central bank we tend to think that since in our currency we cannot go to default, that probably this risk is not as high. Probably it's a little bit wishful sometimes, but especially in small countries, the problem is that beside some budget consolidation, which is politically very tough, there is no real other options to have this issue. Or on the other hand, what is a big hope for the future, but I think at this point it's more like a hope, is the savings and investment union, which is, I think, one of the key points to the EU in the future, since what we see is that a lot of savings are existing within the or in the EU, or we are saving a lot in the EU, and these savings go out of the EU. So keeping the savings within the EU and use it within the EU would be more than important in the future. And also regarding the market, the next slide is more about where we are standing now, and it was a very good chart what John had about the returns of different asset classes, and I just added some few others because it is interesting from several point of view. And in the last year, for me, it was a real big question that did we lose our compass, in the sense that for sure our pricing methodology in finance is really based on that we know some risk-free, and the question is that did we lose the risk-free rate in this year, and if yes, how long is it to change, and what it means? Because if there is no risk-free, or there is a new risk-free, like for example, and this is really just provocative, the gold, then since it has no real return, no interest bearing, then probably the risk-free should be lower, which means a higher equity price. So how to drive ourselves in the financial market in the future from this perspective, because it can be quite tricky to understand what is happening. And it was also a very nice slide to see how the drawdowns changed during time, because it seems that some markets can only go up, although at least the crypto market also always teaches us that markets can go down. So the question is whether there is a change for a long term between different markets, or it is just a new state due to this tariff war and turbulent environment, and we will get back to the old normal, because it will help us to be able to evaluate the risk better in the future as well. And also, I think it was very interesting, and I would go to the next slide to see all the information about corporate bankruptcy, because for sure, from a stability point of view, it is very interesting, and it would be very, very crucial to understand the reason of growing number of bankruptcies. And I'm afraid that we cannot be very sure that what these bankruptcies means, because in the last couple of years, what we have seen is that we not only as a central bank, but more like the state budgets and the European Commission put a lot of money to the companies, and probably at least some part of the companies and some relevant sectors got used to get free money, or at least zero interest rate money, and probably the change in the performance of the companies is more like the result of this withdrawal of strong subsidy. And it is a big question, and I would go to the next slide, whether it is good or bad. For sure, from a stability point of view, the easiest work all the time is when non-performing loan ratio is very low and there is no default, because we can be comfortable in our armchairs, and that's okay. But on the other hand, and I'm just referring to paper, or it was a type of publication by the EBRD about 3 years ago on zombie firms, and I just chose a picture from that publication. Is that it seems that in the last couple of years, due to the strong subsidies of the states and the European Union, probably many of the companies who were living or who could be saved are not the most useful companies for the real economy as a whole. So when I check this chart from the report from 2015 until now, and I see that we, in case of bankruptcies, we got back to the same point. Although the pace of this increase is very fast, probably it can threat us. But on the other hand, for me, it's still a question whether it is bad or it is necessary, because especially after the GFC and especially in the last 10 years, probably we gave too many support to the corporate sector, and probably it is also a burden for the economy and hinders the economy to get back to a healthier state and get back its ability to grow in a much faster pace, because these companies can absorb a lot of sources, at least the workforce, and other companies which may be much more profitable or efficient cannot reach this workforce. So it is a question whether it is healthy or not, or this will be solved by the AI. Probably. I don't have answers, so I'm in a very comfortable position because I'm just giving questions to John, and he will be the one who answers that. And the last point, and the reason why I'm focusing on this point is that we have the same issue in Hungary. And we had this issue for the last decade many times due to different state subsidy programs. Is the residential real estate prices, because I think the consequences of the changes in the residential real estate prices are for sure are not only on the financial stability, but it has social consequences, it has consequences on competitiveness of the economy. So it is a well-positioned market within the economy, and it has a huge relevance. And for this reason, the working of this market is important for probably all the people in our societies. And for sure, what we know all the time is that supply side measures would be essential to help on a sustainable long-term way for the residential real estate market. But from a political perspective, these measures are not very popular, since it can have only good results on a very long term. And I have to refer to the European Commission because they just published their affordable housing paper probably last week, which was very interesting and gave some directions where to go. But those directions are also underlines the fact that it is far from easy to get some result. And the question is that whether there is a country level solution. Probably we can be sure that for central bank and macroprudential policy, still the main issue is to ensure the stable environment with our policy making. And I also have to emphasize that here in the Central Bank of Hungary, we just decided to introduce systemic risk buffer for the banking sector from 2026 January due to the risks on different segments of the real estate market. But still, it is a big question whether there is a country level solution for the affordability problem, because it would be the point where there may be a long-term sustainable solution for those huge cyclical movements on this market, which would decrease the financial stability risks as well. And if there is no country level solution, then what else should we do? Probably a type of eternal subsidy like for the agriculture. It is just an idea, but is there, or we can live, or we have to live with the cyclicality of these markets, what we are facing with? I don't really know that, but I think it is a key issue for the near future, and not just in Hungary, but in the whole EU. So that was all from my side, and thank you very much for the opportunity.
Thank you very much, Ádám, for your thought-provoking points. Dear John, many interesting points have been brought up. Would you want to comment immediately?
Yeah, sure. And let me thank both of the discussants, Cristina and Ádám, for really thought-provoking and constructive comments. Cristina, I remember you did some kind of exercise that was last time as well. I can't remember what it was, but you're...
It's true. I remember that you liked it. So
I like your approach to giving comments. Yeah, I mean, it's really interesting what you got out of the, yeah, I guess there's a kind of a word cloud kind of approach to, yeah, seeing what the main messages are. One thing, because your list of issues that we could have or should have included, which, you know, all of them are relevant, but we actually spend a lot of time trying to sort between what we call vulnerabilities, slow-moving vulnerabilities, and potential sources of shocks. And sometimes, of course, there is a bit of overlap between them, or, you know, one vulnerability can cause another vulnerability to unravel, so it becomes a kind of a shock for the other. So they can sometimes take on the same roles, and this is why we always do make this attempt to try and sort things together into categories. But of course, it doesn't always work perfectly, because I think you picked up that there's kind of some overlap between them. Although what was interesting, what I found interesting was that in your word cloud, where you had the big three, sovereign, MBFI, and leverage, the stretched valuations message was apparently a little bit more diminished than we would have wanted. I mean, in fact, we had the press briefing with Vice President Guindos yesterday, and this was basically, 70% of the questions were on the whole AI bubble topic. So that was what was considered more newsworthy for them. But I mean, this is one of the reasons why we're a little bit delayed with this. Would have liked to have shown something today. Is this trying with these AI approaches, trying to explain to AI what vulnerabilities are? I mean, to try to get it to understand our framework. But of course, then there's also, we have in our own little, echo chamber of people who understand financial stability vocabulary. And then there's outside, who, they couldn't care less about, the way that we structure our ways of thinking. And I mean, of course, we have to be sensitive. But I think that we need to be internally consistent, but we at the same time need to be sensitive to, general public, or at least, expert Financial Times readers, or who our audience is, to communicate with them. And that's a bit, that's where there is, there is a bit of a challenge. One thing as well that we've noted is the importance of also distinguishing, just in very basic things, between statements that are backward-looking and statements that are forward-looking in the text of the FSR, because I mean it's the forward-looking stuff, but it can sometimes pick up the wrong sentiment just because you said something about, we were in this negative. We had this period which was maybe more stressful, and we're coming out of it, but it might pick it up the wrong way and give you the wrong message in terms of sentiment. So I think there is a fair amount of work to be done. I mean, we tried a bit with we actually have the word bubble in the FSR. I mean, I'm not sure if that's the first time we've ever had, but we've been really careful about the way that we worded it. I mean, more put it that it's financial market participants who were concerned about bubble, rather than us saying that it was a bubble. And in fact, the Vice President explained yesterday to the media, I mean, the difficulties in identifying bubbles also. But I mean, I think this distinction, and I think I saw the same LinkedIn posts of Sasha as you did. I mean, this distinguishing between good and bad bubbles, and when credit becomes part of the story, leverage, and the potential for amplification, and all of that you get. So I don't know whether that's really answers, but I mean, I appreciate all of that input. And I mean, I think we're working on many of the issues, the geopolitical stuff, the geoeconomics, I guess the only thing I can say is watch this space, and maybe we should have it. We should have it next time. Adam, you had a couple of questions. I mean, one was, I think that these were the questions, but is the sovereign nexus back? The sovereign bank nexus back, I think, was that one of them? I mean, we're not really seeing that in the euro area. Actually, we're not really seeing any, even though we're warning about these risks, we have remarkably calm conditions in sovereign bond markets at the moment, in the euro area at least. I haven't been following the Hungarian developments so closely lately, so I'm not really, I wouldn't be competent to comment on that. But I mean, we don't really see that. And even where there is, I mean, there has been a bit of divergence in France. We're not seeing it there either. So I mean, so far so good. I mean, of course, there has been many countries, banking systems did reduce their exposure to sovereigns since 10-15 years ago. So I mean, there's an improvement. There's been an improvement there. Your question on, I mean, have we lost the risk-free rate? That's interesting. And that's something there has been this issue of, did the developments that took place in the US starting really in earnest in April, but continuing, has it given rise to a loss of the? I mean, one way of articulating it is just that the risk-free status of the US, and of course there have been downgrades and so on as well. I mean, tell us, market participants tell us, it's not really that. there's a kind of a conditional way of thinking about things now. The Treasury market does still set a kind of a global risk-free rate, but you add a risk premium, or you look at swap rates, or I mean, even some people are saying that this is one of the reasons why we're getting such compressed corporate bond spreads, because corporate bonds for highly graded, high graded issuers. And by the way, I mean, many of these hyperscalers, actually, because they had almost no debt before they started issuing, they can be also setting the risk-free rate. So it doesn't have to be a government rate, but it's, yeah, that's some of the thoughts that we've been hearing on the corporate bankruptcies. I mean, we didn't dig deeply into the data, but I mean, I can say that we can say something about the sectors where there has been, greater impact than another. So it's transport, information and communication, accommodation, food services, and I think some of that reflects, higher energy costs, wage pressures. But the point that you make, and I think you didn't use the zombie word, but we have used it in the FSR in the past. I mean, we did express concern. I think we even presented it here when Tamara was with us, because she did a special feature on that specific topic, and there was a concern that the pandemic government support measures might have prolonged or created even zombies. And those reports have more or less all completely got. There were some measures that went out as far as 6 years, but I think most of them the support is faded now, or are being completely eliminated. So maybe we are seeing some unearthing possibly as well. I wouldn't exclude that at all as a possibility, because it was something, in fact, that we had warned about. And then I don't know. I mean, again, on the housing markets, I would have to be very, very general rather than making prescriptions about how to deal with Hungarian housing market vulnerabilities. But for constrained supply issues, I don't think macroprudential policy is the right tool at all. I mean, it's, increase the supply somehow, build higher, or I don't know what, or build more. But Macropru is, to my mind, it can't really address those kinds of supply side structural issues. Where it works best, and where we found it particularly works best, or the instruments that work best, are the borrower-based measures, the LTV and the DSTI, preferably in combination. I don't know whether they exist or not in your country. In some countries they do, some countries they don't. When they don't,
we do them for sure.
You do them?
We do them both.
Okay, you have them, yeah. I mean, and then another alternative that I've found from some work that I had hoped that would have gone into this FSR, but it didn't. There's some substitutability between LTV and housing taxes, so you can actually get similar effects on housing markets, and it's a more effective measure, I think, for impacting on house prices, if that's what you're aiming for. I mean, but that kind of, is that a macroprudential policy objective or not? We can get into that. We tend to think more that it's indebtedness of households that you want to be. But if you don't have an LTV, you can use the housing tax. That's the point. So there are a number of different instruments that can be used.
Thank you, John. Meanwhile, we have received quite a number of questions from the chat. Let me just pick out a couple of them. There's a question by Olivier Kemla. How is the ECB calibrating macro policies to the current environment? Because in your conclusions, you mentioned macro policies, so maybe you can shed a little light.
So that's what the message. I gave a general message about the principles that we think, that now is not the time to be releasing any kind of macroprudential measures. I mean, we have uncertainty has come down, but it hasn't gone back to baseline. I mean, it's still, I would say, above average, and so the likelihood of shocks is higher than normal. And it's that intuitively, that's not really the right time to be reducing your shock absorption capacity if you think the shocks are going to be more frequent. And we're even advocating that in those cases, because I mean, this was something that we discovered during COVID, that we didn't have a lot of releasable capital. whether or not it was the right thing to do or not to release in the first place. But I mean, you know, if you want to have an instrument that can be counter-cyclical in downturns, then you want to have releasable capital, and some countries have done better in building up buffers than others, and you know, take advantage of you know, a high banking sector profitability that I mentioned as well, which is it's a good time to be building up buffers, and it's unlikely to be pro-cyclical.
If I might follow up on this, you know, you mentioned in your conclusions also simplify the supervisory and regulatory framework without compromising resilience. Now that's of course appropriate, but what precisely do you mean with it?
Yeah, so we'll be reporting from the ECB coming out on that very soon. Our vice president has been chairing a high-level task force, and I don't think I can really comment on that right now beyond the kind of the general, you know, headline principles-based message.
So we should stay tuned for that.
Yeah, no, that's coming. It should be coming soon.
Then I have a question from Gabriel Fagan, our old colleague of both of us.
Old friend of ours, yeah.
Yes.
Indeed.
Are central banks prepared to step in case of liquidity problems? Are operational frameworks designed to adequately respond fast to liquidity shortages triggered by a retreat of NBFIs from non-bank financing? And if I may add to that, how about backstops for sovereign bond markets in case of market panic? And then let me add to that a point that we just discussed by Klaus Masuch, another of our colleagues.
Is he there too?
Yes, he's here too.
They're asking me the hardest questions now.
To the sovereign bank doom loop, which we just discussed. What regulatory reforms are in the cards for this?
God, I don't know what to answer to those questions. I mean, they are a couple of challenging questions. But Gabriel's question. So a situation of a disappearance of liquidity, we get a liquidity shock in the non-bank financial institution sector. I mean, the scenario that I kind of painted a little bit of general detail on, you know, I mean, we've had scenarios like this in the past, and the ECB has been able to respond. I mean, it happened during COVID, for instance, and yeah, I mean, sometimes it depends on the ability of the liquidity to make its way through banks to the NBFIs, because the NBFIs, of course, don't have access to central bank liquidity. So that's kind of makes it a bit complicated. And what can happen, as did happen during COVID, is that if the markets become overwhelmed and we have unstable financial markets, and we've ended up being purchasers of the assets. So, you know, but that's this is why we want to have more oversight of these institutions, because you want to avoid that. I mean, so I think crisis management wise, I mean, a way is always found, but you know, you would rather not get to that point. You would rather, you know, macroprudential policy is a preemptive policy toolkit. It's trying to avoid, you know, it's a crisis avoiding toolkit rather than the crisis management one. So this is why we say more work needs to be done on ensuring that NBFIs have better liquidity buffers and so on. To Klaus, I mean, I don't think that we are on the verge of a doom loop right now on the banking sector. Actually, it's not really it's not, you know, if you look at where we are prioritizing, I mean, I think we have this. The first one is that the order in which I made the presentation is really the prioritization of the risks, and it's the interplay between stretched valuations and NBFI vulnerabilities, where we think that's really, you know, the nexus where vulnerabilities are greatest and where we could see possibly the biggest problems. It's not to say that we haven't flagged, we have flagged sovereign risk as well, but we're really not seeing, I mean, you saw the chart, I mean, the spreads are going down, not up. So these risks that we're flagging, I mean, either it could be complacency, I mean, in financial markets, as some people say, or yeah, maybe there is, you know, optimism that we will get this growth enhancing impact of spending in all of the areas where structural reform needs to take place. You know, it's a kind of a double-edged sword, because you know, but we need this economic structural reform, improving productivity, improving the ability of Europe to defend itself. And I think it's fortuitous that the markets right now don't see that as a financial stability risk in a big way. So you know, but it's a bit. I know how hawkish Klaus is, but this is a kind of, you know, it's a glass half full, glass half empty situation, and I think there is a possibility to navigate through it without creating turmoil in financial markets.
Despite the time constraints, I want to give Ádám and Cristina the opportunity for a final comment.
I think it was very interesting to get some notes from John on this question. For sure, these were those were provocative, and this was my intention. So I didn't think that these are easy to answer, and for sure the Hungarian perspective is a little bit different than that of the EU. But yeah, I think it was very nice to hear those ideas.
Thank you, Cristina.
John, I'm happy that he found some of my comments useful. I was thinking about Adam's question about the real estate market and so on. There's something that we also work with here in Sweden, right? And this new aspect of aging and structural problems, how population is changing, that actually adds to the difficulties into the picture, right? So there are so many challenges. So it's interesting that, yeah, I found that particularly interesting. And also zombie firms, I'm working on it as well. So I'm very interested. I didn't bring it up myself, but it was nice to see, again, you know, a bit more focus on vulnerable firms. I don't like the term zombie firms very much, but vulnerable firm, I think is more appropriate because it's not so. But yeah, thank you very much. It was very insightful for me as well. I have a lot to bring with me in our further discussions here at the Swedish Central Bank. So thanks a lot for the invite again, and for John and Adam's comments. Very insightful. Thank you.
Thank you, Cristina. This concludes our SUERF-BAFFI Bocconi e-lecture on key takeaways from the ECB November 2025 FSR. A great thank you to John, Ádám, and Cristina for your presentations and open discussion, and to all of you for your interest and for your questions and comments. Bye-bye and take care.
Bye-bye.
Thanks a lot.
Thank you very much.
Bye-bye.
Thanks.
Bye.